Hello, I'm David Frazier, the founder of Investors Monitor and the president and chief market strategist of Frazier and Mayer Research LLC, our independent investment research firm. We're recording this week's market factor video on Sunday, February 4th at around 5:30 in the evening. Wow, we had a big sell-off in the U.S. stock market during the past week. And that really comes to no surprise whatsoever to my firm and I. And the reason being is we had warned subscribers to our investment journals, as well as really financial market participants in general, via our weekly market factor video, that stock prices in general had been trading at extended and short-term overbought levels for approximately 3.5 weeks. And because of that, the price momentum, the upward momentum of stocks had just simply slowed. In other words, practically everyone that was thinking about buying stocks during the prior weeks had already done so. And therefore, there were really no new buyers left to push stocks higher. So now we've heard in the general financial media that supposedly the big reason behind the sharp sell-off in stocks during the week of January 29th to February the 2nd was due to inflationary pressures. I mean, you know, I as I do every day of the week, I turned on and listened to numerous financial market shows throughout the day, not for any actual factual information, not to learn about anything that I didn't already know, but simply to gauge the perception of financial market participants. And throughout the day on Friday, February the 2nd, numerous so-called financial market experts, financial market pundits, journalists, mutual fund portfolio managers had commented on the fact that the average hourly earnings of U.S. workers, U.S. employees, rose during January at the fastest pace since 2009, I think it was. I'd have to go back and check. I have all the data. But on a year-over-year basis, the average hourly earnings of U.S. employees rose by 2.9% during January. And now, I heard several so-called experts state that wages of U.S. employees had risen by that degree. And actually, that's not even correct. I'm not going to even get into the details of it. But the fact of the matter is, the overall earnings of U.S. workers was up by the most since, I think, once again, around 2009. And that's a positive development. Interestingly, if you actually look at the average weekly earnings of U.S. employees, they actually declined during January versus the same month a year ago. And the reason for the difference between the two, that is average hourly earnings rising and average weekly earnings declining, is that U.S. employees worked a substantially fewer number of hours during January of this year. Regardless of any of that, so we did have an increase in the overall earnings of U.S. workers, and that's a good thing. But, you know, these so-called experts spoke as if, you know, wow, we got some big inflationary concerns now, and the Fed's going to raise interest rates. Well, first of all, the Fed does not raise interest rates. The Federal Reserve monitors and targets and affects one interest rate, and that is the overnight bank lending rate, the federal funds rate. And it's true that short-term interest rates in general, meaning interest rates from anywhere from a day to up to about 2 years, do tend to move in the same direction as the Fed funds rate. But longer-term interest rates, the Federal Reserve has almost no control over. And they really don't have any control over. You know, longer-term interest rates are determined primarily by the demand for loans by businesses, really, for the most part, as well as the demand for loans by people that are looking to buy a home. And long-term interest rates did trend a bit higher over the past few months, And I think on Friday, February 2nd, for example, the yield on the U.S. 10-year U.S. Treasury note was at 2.84%. And, it's the highest it's been for several months at least. But this is not a concern. And the reason it's not a concern is there's nothing whatsoever that indicates in any way whatsoever that there are going to be any problematic inflationary pressures during the months ahead. So even if interest rates were to go a bit higher, and they might go a bit higher, my research has indicated that inflation rates are nowhere near the level that have caused interest rates in general to rise to very high levels. And interest rates at this time, and my research indicates over the next few months, are currently not at a level, nor will they likely rise to a level that has historically led to big downturns in the U.S. stock market. So let's look at a couple of other factors. I'm going to pull out some notes here. If we look at just the trading action in the U.S. stock market this past Friday, when the Dow Jones Industrial Average just during that one day on Friday was down 660 points. That's where it closed, down 666 points compared to the prior day on Thursday. And the Dow was down 1,096 points for the week ended February 2nd. That's right at 4.1%. The S&P 500 index was down 3.9% for the week. So even though stocks did sell off fairly sharply on last Friday, February the 2nd, as well as for the whole weekend of February 2nd, the trading action in the U.S. stock market suggests that there was no fear, that there wasn't any panic selling. I mean, if we look at what's referred to as the trend index, the short-term trading index, which compares the price action in stocks, the number of stocks advancing in price to the number of stocks declining in price, and then take that ratio of stocks that whose volume increased versus those whose volume of trading decreased. This is called the trend index. It shows that it indicates that there was no panic selling whatsoever, and that there was a lot of buying on dips. Secondly, regarding the trading action in the U.S. stock market, in regard to sector performance, the worst performing sector for the day and on Friday, February 2nd, as well as for the week into February 2nd, stocks of companies that operate in the energy sector were the worst performing stocks during the weekend of February 2nd. And that shouldn't be any surprise at all. And the reason being is energy stocks ran up substantially in price and were the market leaders over the prior 3 weeks. So this of course we saw a sell-off in energy stocks. But stocks of companies that operate in the financial sector and the consumer discretionary sector, that is very cyclical sectors, were the better performing stocks during the weekend of February 2nd. So, if there was a lot of fear or a lot of concern about stock market participants, then we would have seen consumer staple stocks and utility stocks and telecommunication stocks be the best performing sectors. But that's not what happened. Next, once again, looking at some notes here, I can't remember everything. All of the major stock market indices, as well as the stock prices in general, and when I say in general, I mean I looked at the trading action in probably about 300 stocks over the weekend. They moved lower this past week, but they held right at key price support levels, and this is very, very significant. So if we take those factors, all of those factors, the fact that stocks had been trading at substantial overbought levels during each of the prior 3 weeks, the fact that consumer discretionary stocks and financial stocks actually outperformed most other stocks during the weekend of February 2nd, and the fact that stock prices in general held near major price support levels, my experience and research indicates that we're going to have a big rebound during stocks during the week of February 5th to the 9th. And once again, the fact that we're not seeing any significant inflationary pressures, there's nothing to indicate that interest rates are going to rise to any problematic levels. My opinion is, once again, we're going to see a big rebound in stocks during the week ahead. Now, so what stocks do you put your money on? Do you do any buying during the coming week? Well, my opinion is, yes, you do some buying. I have several stocks that I've been monitoring for months that I've been waiting for a pullback to recommend to persons who subscribe to our investment publications. So if you'd like to keep up with the factors and developments that really matter, to know when you should be getting primarily out of the stock market, and when you should be not concerned in adding to your stock positions, as well as in which individual stocks and sectors of the market you probably should be investing for the biggest returns, then I encourage you strongly to subscribe to one of our investment publications. You can do so by going to our internet website at investorsmonitor.com. There's a link right underneath this video where there's a brief description of the video. There's a link that I put in there that will take you directly to a subscription page that you can subscribe to our investment publications, our individual publications, for only $99 for the next 3 months to our exponential growth opportunities, and only $79 for the next 3 months to our Frazier strategic allocator. So I'm going to wrap it up there. I welcome the downturn that we had in the stock market during the weekend of February 22nd. And once again, my research and experience suggests that we're going to rebound substantially during the week ahead. So I thank you for listening and watching, and I'll speak with you again next week.